And we are live. Hey guys, welcome back to the stream. Good morning. Hey guys, yesterday I couldn't stream because I woke up like late. I woke up like so late actually because I slept very late also. Uh, there was a function day for yesterday, so after that I became like home so late and I slept like 3 hours, like 3 hours late to my regular time, regular sleeping time, right? So the routine, once it breaks, it's difficult, man. So I woke up also like around 2.5, 3 hours late. So that was like the time for the stream. I was sleeping, I was sleeping peacefully during the stream time. And the problem, it's not the problem, right? So I usually wake up without alarm. There is no alarm clock actually. So I just usually randomly wake up around like 3:30, 3:15, 3:30. Around that time I wake up. But the other day, because I slept late and the routine's gone, right? So I woke up late. Uh, Again, today also it was kind of difficult. Today also I woke up a bit late, but like around 3:45. Yeah, that's what happens once you break the routine. So I don't want to break the routine. Okay, guys. So let's see. Where were we? We discussed chapter 4, right? Debt money system, origins and mechanics. Wait. So this one we finished. No, we didn't finish it. We were in the middle. We just started it. Let me check. Yeah, chapter 4. Yeah, we are in the middle of chapter 4. Okay, let's continue it. I don't know which subtopic we stopped. We will start with this. The role of central banks in debt money system. Central banks play a crucial role in debt money system. They are responsible for implementing monetary policy and regulating the money supply in the economy. Central banks also act as lenders of last resort to commercial banks during times of financial crisis. One of the primary functions of central bank is to control the supply of money in the economy. They do this through various tools such as setting interest rates, managing the reserve requirements for commercial banks. The central bank also has the power to create money by purchasing government bonds and other financial assets from commercial banks. This increases the money supply in the economy and can help stimulate economic growth. Central banks also play a crucial role in maintaining the stability of the financial system. They oversee the operation of commercial banks and ensure that they are operating in a safe and sound manner. Central banks can provide in central banks can step in to provide liquidity to banks during times of crisis to prevent bank runs and other financial panics. The photic sneeze reflex is kicking in. Why? Overall, the role of central banks in the debt money system is essential for maintaining stable economic growth and financial stability. They act as regulators, lenders of last resort, and controllers of money supply, all of which are crucial for a healthy financial system. Next, fractional reserve banking and its role in debt money system. Fractional reserve banking is a system where banks keep only a fraction of deposits made by their customers while lending out the remainder to other borrowers. This creates a multiplier effect that enables banks to create new money by issuing loans, which then circulates through the economy. This system has become a fundamental part of debt money system as it allows for the creation of new money through the extension of credit. The practice of fractional reserve banking has a long history. dating back to goldsmiths in the Middle Ages who used to store gold and other valuables for customers. They soon discovered that not all customers would come to collect their gold at the same time, and they could lend out some of the gold to earn interest while still keeping enough on hand to meet their customers' demands. This led to the creation of a new form of money, as the gold receipts issued by the goldsmiths became widely accepted as a medium of exchange. Today, most modern banking systems operate on a fractional reserve basis, with central banks regulating the amount of reserves that commercial banks must hold. This regulation is designed to ensure the stability of the financial system and to prevent excessive creation of new money, which can lead to inflation. However, critics argue that fractional reserve banking enables banks to create money out of thin air, which can lead to financial instability and contribute to income inequality. Next, creation of money through debt and the multiplier effect. The creation of money through debt and the multiplier effect is a fundamental mechanism of the debt money system. It is based on the fact that banks create new money by extending loans to individuals, businesses, and governments. This process begins when a borrower approaches a bank for a loan. If the bank approves the loan, it creates new deposit for the borrower, which is essentially new money. This new deposit is backed by the borrower's promise to repay the loan and the bank's reserve requirement, which is a fraction of the total deposit. Once the new deposit is created, it becomes a part of the money supply and can be used to purchase goods and services. However, the borrower may deposit the loan amount in another bank, which creates new deposit and the process continues. This is known as the multiplier effect, where a single loan can create multiple deposits and the money supply increases exponentially. This mechanism has both positive and negative effects on the economy. On the one hand, it increases the money supply, which can boost economic activity and stimulate growth. On the other hand, it can also lead to inflation, as the increased money supply can reduce the purchasing power of each individual unit of currency. The creation of money through debt and the multiplier effect is a complex process that is carefully regulated by central banks and governments. Proper management of this mechanism is critical for maintaining economic stability and ensuring the long term health of the economy. The impact of interest rates on debt money system. Interest rates play a crucial role in the debt money system. Central banks, through monetary policy, can control interest rates, which can impact borrowing, lending, and money creation. When interest rates are low, it becomes easier and cheaper for businesses and individuals to borrow money. This results in an increase in spending, which can boost economic growth. In addition, lower interest rates can increase the demand for loans, which can increase the money supply through the multiplier effect. On the other hand, when interest rates are high, borrowing becomes more expensive, which can result in a decrease in spending and a decrease in the money supply. This can lead to a decrease in economic growth and potentially even a recession. Hola, El Shadel YouTube. Hola. Hey bro. I don't know Spanish. I know it's Spanish. That's the only Spanish I know. Okay. Furthermore, high interest rates can also lead to higher levels of debt as individuals and businesses struggle to pay back loans with high interest rates. This can create a debt trap, which can result in default, bankruptcy, and economic instability. Central banks often use interest rates as a tool to maintain price stability, control inflation, and promote economic growth. However, the impact of interest rates on the debt money system is complex and it requires a delicate balance between promoting economic growth and stability while avoiding excessive levels of debt and inflation. How debt money system creates inflation. Debt money system is inherently linked with inflation. Inflation is the general increase in prices of goods and services in an economy over time. When the supply of money in an economy increases rapidly, it leads to inflation. In a debt money system, money is created when loans are made, and this creates new money in the economy. When more and more loans are made, the money supply increases, leading to inflation. The creation of money through debt has also a multiplier effect. When a bank makes a loan, the money created through the loan is deposited in another bank, and that bank can use that money to make another loan. This process continues, leading to a multiplication of the money supply in the economy. Inflation can also occur when the demand for goods and services exceeds the supply. In a debt money system, when banks make loans, it leads to increased demand for goods and services, which can exceed the supply, leading to inflation. Central banks can try to control inflation by adjusting interest rates, which affects the cost of borrowing money. When interest rates are low, borrowing is cheaper, leading to more borrowing and more money creation, which can lead to inflation. When interest rates are high, borrowing is more expensive, leading to less borrowing and less money creation, which can help control inflation. Overall, the debt money system creates inflationary pressures that must be managed by central banks through interest rate adjustment and other policies. The impact of debt money system on economic growth and stability. The impact of debt money system on economic growth and stability has been a subject of debate among economists and policymakers. Proponents of the system argue that it promotes economic growth by providing credit to individuals and businesses, which fuels investment and creates jobs. On the other hand, critics argue that the system creates instability by promoting excessive borrowing, which can lead to financial crisis and economic downturns. One of the main ways that the debt money system can impact economic growth and stability is through its impact on the level of debt in the economy. The more debt that individuals and businesses accumulate, the higher the risk of default and the greater the potential for financial instability. Additionally, the debt money system can also contribute to economic inequality by favoring those with access to credit while limiting opportunities for those without it. The debt money system can also impact the stability of the financial system through the creation of asset bubbles. As credit is more as credit is made more readily available, asset prices can rise rapidly, leading to an unsustainable increase in asset values. When these bubbles burst, the resulting economic fallout can be severe and long lasting. Overall, while the debt money system has the potential to promote economic growth and development, its impact on economic stability must be carefully managed to avoid the negative consequences associated with excessive borrowing and financial instability. The role of government in regulating debt money system. The role of government in regulating debt money system is critical to maintaining economic stability and preventing financial crisis. One way the government regulates this system is by setting reserve requirements for banks, which determine how much money can lend out, how much money banks can lend out based on the amount of reserves they hold. By adjusting these requirements, the government can control the amount of money in circulation and, and the potential for inflation. Another important role of the government is to regulate interest rates. High interest rates can slow economic growth, while low interest rates can stimulate borrowing and spending. To central bank, which is often controlled by the government, can adjust interest rates to maintain economic stability. Additionally, the government can use fiscal policy to influence the debt money system. This includes government spending and taxation policies, which can affect the amount of money in circulation and overall health of the economy. Overall, the government plays a crucial role in regulating the debt money system to ensure economic stability. But it must balance this with the need to support economic growth and development. Effective regulation can help prevent financial crisis and support long-term economic prosperity. Criticism and controversies surrounding debt money system. The debt money system has been subject to numerous criticisms and controversies. One of the primary criticisms is that it leads to a perpetually increasing debt burden for individuals, corporations, and governments. Since the system creates money through debt, the amount of debt in the economy must constantly increase to support economic growth, leading to a debt spiral that can become unsustainable. Another criticism of debt money system is that it allows for the creation of money without any tangible backing, which can lead to inflation and decreased purchasing power. This is because the supply of money can increase rapidly, leading to a decrease in the value of each individual unit of currency. The role of banks in the debt money system has also been criticized, with some arguing that fractional reserve banking allows banks to create money out of thin air and profit from the interest charged on loans. This has led to calls for reform of the banking system to limit the power of banks to create money. Finally, some critics argue that the debt money system perpetuates economic inequality, as those with access to credit and the ability to take on debt can benefit from the system, while those without access to credit or with high levels of debt may struggle to participate in the economy. Overall, while the debt money system has played a crucial role in modern economies, it has also been the subject of ongoing debate and scrutiny, with calls for reform and alternative systems of monetary policy. Chapter 5: Bond Money System Concept and Impact. Let me write it down. Bond Money System. Definition of bond money system. A bond money system is a monetary system in which government bonds serve as the foundation of money supply. In this system, the government issue bonds to raise funds for public projects and programs which are then purchased by investors. These bonds are considered a safe investment because they are backed by the full faith and credit of the government. The bond money system is different from the debt money system, in which banks create money by lending out funds that they do not actually have in resource. In the bond money system, the government creates money by issuing bonds, which are bought by investors using existing money. The bond money system allows government the bond money system allows government to raise funds for public expenditures without resorting to inflationary policies. By selling bonds to investors, the government can finance public projects and programs without printing money or increasing taxes. This allows government to manage the money supply and control inflation more effectively. The bond money system also allows for greater transparency and accountability. Since government bonds are publicly traded and their yields are closely monitored, it is easier for investors and the public to track government spending and borrowing activities. Additionally, the bond market can provide signals to policymakers regarding the state of the economy and the direction of monetary policy. Historical background of bond money system. The bond money system has a relatively modern origin compared to other monetary systems. It began in the late 17th century when the British government started issuing bonds to finance wars and other public expenditures. These bonds were essentially debt instruments that promised to pay the holder a fixed interest rate over a certain period of time. The bonds were sold to investors who were willing to lend money to the government, and the government used the proceeds to finance its activities. The bond money system gained prominence in the 20th century, particularly after the Great Depression and World War II. In many countries, governments started relying on issuing bonds to finance large scale infrastructure projects such as highways, dams, and airports. These bonds were seen as a safe and stable investment, and they helped government raise large sums of money without resorting to inflationary measures or high taxes. Today, bond markets are among the largest and most liquid financial markets in the world. Governments issue bonds with varying maturities, from short term treasury bills to long term bonds that mature in 30 years or more. The bond money system has also been adopted by many corporations and other entities that issue debt securities to raise funds for their operations. Overall, the bond money system has become an integral part of modern finance and has helped governments and businesses around the world finance their activities and grow their economies. Differences between bond money system and debt money system. The bond money system and the debt money system are two distinct monetary systems, each with its own characteristics and impact on the economy. The main difference between the two is the way they create money. In a debt money system, money is created when banks lend money to individuals or businesses, and this creates debt in the economy. The money supply is determined by the amount of debt that is created. On the other hand, in a bond money system, the government issues bonds to borrow money from investors. The bonds are a promise to pay back the borrowed money with interest over a certain period. When people buy the government bonds, they are effectively loaning money to the government. Another significant difference is the role of the government in the two systems. In a debt money system, the government's involvement is limited to regulating the banks that create money through lending. In contrast, in a bond money system, the government is the main borrower and the bonds issued are used to finance government spending on various projects and programs. Furthermore, the impact of the two systems on the economy is different. In a debt money system, the creation of money through debt can lead to inflation, while in bond money system, the impact of on inflation is less direct. The interest rate on government bonds can affect borrowing costs for businesses and individuals, which can impact economic growth and inflation. Overall, the debt money system and the bond money system have different characteristics and impacts on the economy. The choice between the two depends on the country's economic policies, goals, and priorities. The role of government in bond money system. The government plays a critical role in the bond money system. Unlike the debt money system, where central banks control the money supply, in the bond money system, the government issues bonds to finance its spending. The bond represent a promise by the government to pay back the borrowed amount plus interest at a future date. The government uses these bonds to raise capital from investors such as individuals, financial institutions, and foreign governments. The government's ability to issue bonds is based on its credit worthiness, which is determined by its fiscal policies and economic stability. The higher the government's credit rating, the lower the interest rates on its bonds, and the easier it is for the government to borrow money. Therefore, maintaining a good credit rating is crucial for the government to ensure access to affordable borrowing. The government also plays a role in setting the interest rates on bonds. When the government is in need of more capital, it may increase the interest rates on bonds to attract more investors. Conversely, when the economy is strong, the government may reduce interest rates on bonds to stimulate spending and economic growth. In addition, the government uses the bond market to implement monetary policy. Central banks may purchase government bonds in the open market, injecting liquidity into the economy and lowering interest rates. On the other hand, the central bank may sell bonds to decrease money supply, raising interest rates and curbing inflation. Overall, the government plays a crucial role in the bond money system and its policies can have significant impact on the economy. The concept of government bonds and their purpose. Government bonds are financial instruments issued by the government to raise money from investors. Essentially, when you buy a government bond, you are lending money to the government for a set period of time, and in return, you receive a fixed interest rate. The purpose of government bonds is to provide a source of funding for the government to finance its various projects such as building infrastructure, providing social services, and funding its budget deficits. Government bonds are considered to be among the safest investments available as they are backed by the full faith and credit of the government. The interest rates offered on government bonds is typically lower than that of other investments such as stocks or corporate bonds, but they are viewed as a stable and reliable source of income. There are different types of government bonds such as treasury bills, notes, and bonds, which vary in terms of their maturity and interest rates. Treasury bills have the shortest maturity of less than a year, while treasury note and bonds have a maturity up to 30 years or more. The longer the maturity of the bond, the higher the interest rate offered. Overall, government bonds play an important role in the bond money system as they provide a secure investment option for individuals and institutions, while also allowing the government to raise the necessary funds for its various projects and expenses. Types of government bonds and their characteristics. Government bonds are debt securities issued by national governments to raise funds for public projects such as infrastructure development, education, and healthcare. There are several types of government bonds, each with its unique features. Treasury bonds. These are long term government bonds with a maturity of more than 10 years. Treasury bonds offer fixed interest payments semi annually until maturity, and their market price fluctuates with interest rate changes. Treasury notes. These are medium term government bonds with a maturity period of 1 to 10 years. They offer fixed interest payments twice a year until maturity and are less volatile than treasury bills. These are short term government bonds with a maturity period of less than 1 year. They are sold at a discount to their face value, and investors receive the full face value upon maturity. Treasury bills are popular for their safety, liquidity, and low default risk. Next, indexed bonds. These bonds that offer a return linked to the inflation rate. The principal value and interest payments of these bonds increase or decrease based on changes in the consumer price index or CPI. Next is zero coupon bonds. These bonds that do not offer periodic interest payments. Instead, they are issued at a discount to their face value, and investors receive the full face value upon maturity. Municipal bonds. These are bonds issued by local governments, including cities, counties, and school districts, to fund public projects. Municipal bonds offer tax benefits and are a popular investment choice for investors seeking tax and exempt income. How bond money system affects interest rates and borrowing cost. The bond money system has a significant impact on interest rates and borrowing cost. When the government issues bonds, investors purchase them, essentially lending money to the government. The interest rates on these bonds, called the yield, is determined by the market demand for the bonds and the perceived risk of default. If the demand for bonds is high, their prices increase and the yield decreases. This decrease in yield affects interest rates through the economy, leading to lower borrowing costs for individuals and businesses. Conversely, if the demand for bonds is low, their prices decrease and the yield increases, resulting in higher borrowing costs. The bond money system also affects the monetary policy of the central bank. In some cases, the central bank may purchase government bonds, which increases the demand for the bonds and drives down the yields. This increase in demand for bonds also increases the money supply, leading to lower interest rates and potentially higher inflation. Additionally, the yield on government bonds is often used as a benchmark for other types of borrowing, such as corporate bonds and mortgages. This means that changes in government bond yields can have a ripple effect on other interest rates throughout the economy. Overall, the bond money system plays a crucial role in determining interest rates and borrowing costs, and it is closely monitored by central banks and investors alike. The impact of bond money system on the economy and monetary policy. The bond money system can have a significant impact on economy and monetary policy. By issuing bonds, the government can raise money to finance its expenditures, such as public infrastructure projects and social programs. This can have a positive impact on economic growth and development, as well as provide investors with a secure and stable investment opportunity. At the same time, the bond market can also affect monetary policy. Interest rates on bonds can be an indicator of the overall health of the economy, and the central banks may use this information to set interest rates and adjust monetary policy accordingly. For example, if the economy is showing signs of weakness, a central bank may lower interest rates to encourage borrowing and stimulate economic activity. However, the bond money system can also have negative consequences. If the government issues too many bonds, it can lead to an increase in government debt and potentially high interest rates, which can lead to inflation and a decrease in economic growth. Additionally, if investors begin to lose faith in the government's ability to repay its debts, they may demand higher interest rates, making it more difficult and expensive for government to issue bonds in the future. Overall, the bond money system can be a useful tool for governments to finance their expenditures and stimulate economic growth, but it must be carefully managed to avoid negative consequences on the economy and monetary policy. Advantages and disadvantages of bond money system. The bond money system has its own set of advantages and disadvantages. One of the advantages is that it provides a reliable source of financing for the government. By issuing bonds, the government can raise funds to finance its activities such as infrastructure development or social programs. This can help boost economic growth and provide job opportunities. Moreover, the bond money system can also help stabilize interest rates in the economy, which can contribute to overall economic stability. However, there are also several disadvantages disadvantages associated with the bond money system. One of the main disadvantages is that it can lead to an increase in national debt, which can create long term fiscal challenges. Additionally, the bond money system can also lead to an increase in interest rates as investors demand higher returns on their investments. This can increase the cost of borrowing for both the government and private individuals, which can negatively affect economic growth. Furthermore, the bond money system can also be subject to market fluctuations and investor sentiment. If investors lose confidence in the government's ability to repay its debts, they may demand higher returns, leading to higher interest rates and a more expensive cost of borrowing. In extreme cases, this can lead to a debt crisis where the government may default on its obligations. Overall, while the bond money system has its benefits, it is important for governments to carefully manage their debt levels and investor sentiment to avoid potential negative consequences. Criticisms and controversies surrounding bond money system. The bond money system has faced criticism and controversy since its inception. One of the main criticisms is that it can lead to government overspending, as the ability to borrow money through issuance of bonds can make it easier for governments to spend beyond their means. This can lead to inflation and other economic problems, especially if the government is unable to pay back the bonds in a timely manner. Another criticism is that the bond market can be volatile and unpredictable, leading to fluctuations in interest rates and borrowing costs. This can make it difficult for businesses and individuals to plan their investments and expenses. Additionally, some argue that the bond money system can perpetuate income inequality, as those who are able to invest in government bonds may benefit from the interest earned, while those who cannot afford to invest may not see any benefits. There are also concerns about the impact of the bond money system on future generations, as the debt accumulated through government borrowing will need to be paid back by future taxpayers. Overall, the while the bond money system has its advantages in terms of providing a means for governments to fund public projects and programs, it also faces significant criticisms and controversies that require careful consideration and regulation. Chapter 6: Debt free money systems, types, and examples. Okay. Now, with the book here, it's kind of difficult to write. I have this notebook here to note down things. But again, another problem is when the notebook is not there, the writing pad is actually pressing the keys on the keyboard randomly. I mean that's how last last stream, right? It got muted accidentally. Definition of debt-free money system. A debt-free money system is a monetary policy where money is created and circulated without the need for borrowing or debt. In such a system, the government or central bank create money without any corresponding debt obligations to repay. Unlike the debt money system, where money creation is tied to debt, in a debt free money system, money is created based on the government's mandate and is not linked to the repayment of loans. There are two main types of debt free money system. commodity money, and fiat money. Commodity money is a type of money that has intrinsic value and is usually made of a valuable commodity like gold or silver. On the other hand, fiat money is not backed by any commodity and has value only because the government has declared it as legal tender. In a debt free money system, the government or the central bank is solely responsible for creating and regulating the money, creating the supply of money in the economy. The money created is not accompanied by a corresponding debt obligation to be repaid, and hence there is no interest burden on the economy. The concept of a debt free money system is not new and has been implemented in various forms throughout history. Proponents of debt free money systems argue that they can lead to greater economic stability, reduce debt burdens, and increase public spending on social programs. However, critics argue that systems such systems can lead to inflation, reduce incentives for saving, and political interference in monetary policy. Historical background of debt free money systems. The history of debt free money systems dates back to ancient times with the use of commodity money such as gold and silver as a medium of exchange. The use of commodity money was based on the intrinsic value of the precious metals, which made it a stable and reliable form of currency. However, commodity money also has limitations such as scarcity and difficulty in transportation and storage. In the late 18th and early 19th centuries, there were movements for debt free money systems, which aimed to create a more stable and flexible monetary system. The greenback system introduced during American Civil War was a debt-free money system that allowed the US government to issue paper money backed by the government's credit rather than by gold or silver. The system was successful in financing the war and stimulating the economy, but it was eventually replaced by a gold-backed currency system. Another example of a debt-free money system was the social credit movement, which originated in Canada in the early 20th century. The movement proposed the creation of money by the government and its distribution directly to citizens as a means of stimulating economic growth and reducing poverty. In recent years, there has been renewed interest in debt free money systems, particularly with the rise of cryptocurrencies like Bitcoin, which operate on a decentralized system without the need for a central authority or government. Different types of debt free money systems, such as commodity money and fiat money. Debt free money systems can be categorized into two types: commodity money and fiat money. Commodity money is a type of debt free money system where the currency has an intrinsic value based on the commodity it represents. Historically, precious metals such as gold, silver, and copper have been used as commodity money. The value of commodity money is determined by the market demand for the commodity itself rather than the value placed on it by the government or central authority. The advantage of commodity money is that it has intrinsic value, making it difficult to manipulate or inflate its value. However, the supply of commodity money is limited by the availability of the underlying commodity, which can lead to deflationary pressures. Fiat money is a type of debt free money system where the currency has no intrinsic value and its value is derived solely from the government's authority to issue it as legal tender. The value of fiat money is based on the public's confidence in the government and the economy it represents. Fiat money is created through the central bank and commercial banks in a debt free manner. This means that the money created without the need for corresponding debt obligation. The advantage of fiat money is that it is easily created and can be used to stimulate the economy through monetary policy. However, it is subject to inflationary pressures if too much money is created, and its value can be easily manipulated by the government. Characteristics of debt-free money systems such as scarcity, durability, divisibility, and portability. Debt-free money systems have different characteristics from debt money systems, and these features may vary depending on the type of debt-free money system in question. One common characteristic of debt-free money systems is their scarcity, which is usually achieved by limiting the supply of the currency to prevent inflation. Commodity money systems, for instance, use a scarce commodity such as gold or silver as the basis for their currency. Fiat money systems, on the other hand, rely on government backing and control of the money supply to maintain their value. Another characteristic of debt free money systems is durability. The currency must be able to withstand wear and tear to ensure its longevity and continued circulation. For instance, commodity money systems using gold or silver coins are highly durable due to the metal's physical properties. Divisibility is another important characteristic of debt free money systems. The currency must be easily divided into smaller units for smaller transactions. Commodity money systems have traditionally used coins of varying denominations, while fiat money systems rely on paper notes and electronic transfers. Finally, portability is an essential characteristic of debt-free money systems, allowing them to be easily transported and exchanged across different regions. Portable currencies make trade and commerce more efficient and allow for the growth of economic activity. Commodity money systems have historically been highly portable due to inherent value of the currency, while fiat money systems rely on efficient banking systems to facilitate exchanges. Examples of debt-free money systems in history, such as the tally stick system and the Vogel experiment. Throughout history, there have been numerous examples of debt-free money systems that were implemented by various communities and governments. One of the earliest known examples is the tally stick system, which was used in England from 12th century until the early 19th century. In this system, pieces of wood or other materials were marked and split in half, with one half representing the debt and the other half serving as a receipt. These sticks could be used as a medium of exchange with no need for the creation of debt. Another example is the Vogel experiment, which was conducted in Austrian town of Vogel during Great Depression. The town issued its own currency known as stamp scrip, which was used in conjunction with the national currency. The stamp scrip had an expiration date, and the holders were charged a small fee for not spending it within a certain period. This encouraged rapid circulation of currency and led to an increase in economic activity and employment in the town. More recently, there have been efforts to create alternative currencies and payment systems that operate outside of the traditional debt based monetary system. For example, cryptocurrencies like Bitcoin and Ethereum operate on a decentralized blockchain network and are not tied to any government or central bank. These currencies are created through a process known as mining and can be used to make purchases and transactions without the need for a traditional bank account. Modern examples of debt free money systems, such as the greenback systems and the social credit system. The greenback system is a debt free monetary system that was implemented in the United States during the Civil War era. It involved the issuance of paper currency that was not backed by gold or any other commodity, but rather by the faith and credit of the government. The greenbacks were used to finance the war effort and were accepted as legal tender for all debts, public and private. The system was successful in stabilizing the economy and funding the war, but was ultimately replaced by gold-backed system in 1879. The social credit system is a debt-free monetary system that was proposed by the British engineer and economist C.H. Douglas in the early 20th century. It involves the creation of credit by the government and distribution of that credit to citizens as a dividend. This dividend would increase people's purchasing power and stimulate economic activity without the need for debt based financing. The system has been implemented in various forms in several countries, including Canada, where it was briefly used in the province of Alberta during the Great Depression. Other examples of modern debt free systems include local currencies such as the Brixton pound in London and cryptocurrencies such as Bitcoin. These systems operate independently of traditional banking systems and central authorities, and their value is based on supply and demand in their respective markets. While these systems have gained popularity among other communities, they are not yet widely accepted as a replacement for traditional debt based currencies. How debt free money systems differ from debt money systems in terms of their creation and circulation. Debt free money systems differ from debt money system in their creation and circulation. In debt free money system, money is created without the need for a corresponding debt. The government or central authority can simply create and issue the money into circulation without any obligation to repay or earn interest on that money. On the other hand, in a debt money system, money is created through loans, which are essentially promises to repay with interest. This means that every dollar of money in circulation is backed by a corresponding debt that must be repaid. The creation of money in a debt money system is therefore dependent on the willingness of individuals and institutions to borrow and repay the loans. In a debt free In a debt free money system, money is typically created by the government or central authority and is spent into circulation through government spending or investment. The money supply is therefore not dependent on the willingness of individuals or institutions to borrow and repay loans. Furthermore, in a debt free money system, money can circulate indefinitely without the need to continuously borrow new money to pay off old debts. In a debt money system, however, there is the need to constantly repay debt with interest can create a cycle of perpetual borrowing and indebtedness. Overall, the main difference between debt free and debt money system is the way in which money is created and circulated. With the debt free money systems allowing for a greater degree of control and stability in the money supply. Advantages and disadvantages of debt free money systems compared to debt money systems. Debt free money systems have some advantages over debt money systems. One of the main advantages is that debt free money systems avoid the need for borrowing and interest payments, which can reduce the burden on individuals, businesses, and governments. In a debt free system, the money supply can be increased without incurring debt or interest payments. This can be particularly useful during times of economic recession when governments may need to inject more money into the economy to stimulate growth. Another advantage of debt-free money systems is that they are less susceptible to financial crisis caused by excessive debt. In a debt money system, too much borrowing can lead to buildup of unsustainable debt levels, which can lead to financial instability and economic crisis. In contrast, debt-free money systems do not rely on borrowing, so there is less risk of financial crisis caused by excessive debt. However, there are also some disadvantages to debt-free money systems. One major disadvantage is that it can be difficult to control the money supply in a debt-free system. In a debt money system, the central bank can adjust interest rates to control the money supply. In debt-free money system, however, There may be no effective way to control money supply, which can lead to inflation or deflation. Another disadvantage of debt free money systems is that they may be more susceptible to political influence. In a debt money system, the central bank is generally independent of political control, which can help to ensure that monetary policy decisions are made based on economic factors rather than political considerations. In a debt free system, however, the government may have more control over the money supply, which could lead to decisions based on political rather than economic factors. The role of government in implementing and regulating debt free money systems. The role of government in implementing and regulating debt free money systems can vary depending on the specific system in question. In some cases, such as with commodity money, the government may play a more limited role as the value of the money is determined by the market value of commodity itself. However, in other cases, such as with fiat money, the government has a much more active role in implementing and regulating the system. In the case of fiat money, the government is responsible for creating and managing the money supply and therefore has significant control over the economy. This includes setting interest rates, managing inflation, and controlling the flow of money through various channels. In order to maintain stability and prevent economic disruptions, governments typically work to closely regulate the money supply and ensure that it is growing at a consistent and sustainable rate. Governments may also play a role in promoting or incentivizing the use of certain types of debt free money systems, such as local currencies or community based credit systems. This can be done through programs that provide funding or other forms of support to these systems, as well as through policies that encourage businesses and individuals to use these alternative currencies. Overall, the role of government in implementing and regulating debt-free money systems is an important one, as it can have a significant impact on the stability and sustainability of the economy. By carefully managing the money supply and promoting the use of alternative systems, governments can help to create a more resilient and inclusive financial system that benefits everyone. Criticisms and controversies surrounding debt free money systems. Debt free money systems have been subject to criticism and controversy, with many questioning the feasibility and effectiveness of such systems. One of the main criticism of debt free money system is that they lack the flexibility of debt money system in corresponding to changes in the economy. Since the money supply in debt free systems is fixed, there is limited scope for adjusting the supply to match changes in demand or economic growth. Another criticism of debt free money system is that they may be prone to inflation if the money supply is not managed carefully. This can happen if the supply of money exceeds the growth of the economy, leading to a decrease in the value of money. Critics also argue that debt free money systems may not be able to fund large scale government programs or investments, as they rely on a fixed supply of money rather than the ability to borrow from the market. Additionally, the lack of interest on debt free monies may discourage saving and lead to less investment in the economy. Wait, the lack of interest on debt money may discourage saving. No, it will encourage saving, right? I don't get it. Moreover, some critics argue that debt free money systems are vulnerable to abuse by governments and other entities with the power to create and control the money supply. Without proper regulation, this can lead to corruption and instability. Despite these criticisms, proponents of debt free money systems argue that they offer greater stability and predictability than debt money systems. They also point to successful historical examples of debt free money systems such as talistic system and the Vogel experiment. Ultimately, the debate over the merits and drawbacks of the debt free money system continues to be a topic of discussion among economists and policy makers. I look sleepy, right? I'm actually yawning also. Hmm. Well, I told, right? I woke up a bit late, so I didn't have my tea. Maybe that's the reason I'm feeling sleepy. I didn't get my wake up tea. It's fine. Okay, chapter 7, fractional reserve banking. We discussed this. So, this was part of uh, the other book, right? Capital Gain. But I think in this, we are going into the details, like technical details. So, that was more of a historical details and the development around evolution. But this one is more technical. Chapter. Definition of fractional reserve banking. Fractional reserve banking refers to a banking system in which only a portion of the total deposits made by customers is kept in reserve by banks, while the remainder is loaned out or invested. This means that banks hold only a fraction of the deposits made by their customers as cash or in a reserve account with the central bank. The rest of the funds are used by banks to make loans, purchase securities, or invest in other assets. For example, if a bank has a reserve requirement of 10%, it is required to hold 10% of the total deposits made by its customers as reserves. The remaining 90% of the deposits can be used to not create, to make loans or investments. This creates a multiplier effect as the loaned or invested funds can be deposited into other banks, which in turn can lend out a portion of those funds. Fractional reserve banking allows banks to earn interest on loans and investments, which contributes to their profitability. However, it also exposes banks to the risk of bank run, in which customers rush to withdraw their deposits all at once, leading to a liquidity crisis for the bank. In addition, fractional reserve banking can contribute to the expansion of money supply and potentially lead to inflation. Historical background of fractional reserve banking. Fractional reserve banking has a long history dating back to ancient times where moneylenders would keep only a portion of the deposits as reserves while lending out the rest. However, the modern system of fractional reserve banking began to emerge during the 17th century in Europe, particularly in the Netherlands and England. During this period, goldsmiths began to issue receipts for deposits of gold, which could be redeemed at any time. These receipts became popular as a means of exchange and eventually evolved into banknotes. Banks soon realized that they could lend out a portion of their depositors' money while keeping only a fraction in reserve to meet any potential withdrawals. This practice allowed banks to earn interest on the loans and generate profits. In the 19th century, Fractional reserve banking became more widespread and played a significant role in the growth of the global economy. Banks could create money by lending out a portion of their deposits, which fueled economic growth and development. However, this also made the system vulnerable to bank runs and financial panics, as depositors rushed to withdraw their money and banks were unable to meet their demands. The modern system of fractional reserve banking is highly regulated by governments and central banks, which set reserve requirements and monitor the system for potential risks and vulnerabilities. Despite its long history, fractional reserve banking remains a controversial topic among economists and policymakers, with ongoing debates about its advantages and drawbacks. The mechanism of fractional reserve banking. The mechanism of fractional reserve banking is based on the concept that banks are required to hold only a fraction of their deposits as reserves and allowed to lend out the remainder. For example, if a bank has $100 in deposits and reserve requirement is 10%, the bank is required to keep $10 as reserves and can lend out the remaining $90. This creates new money in the economy as the borrower can then deposit $90 in another bank, which can then lend out a portion of it, and so on. This process of deposit, loan, and redeposit continues, creating new money in the economy. The mechanism of fractional reserve banking works because not all depositors withdraw their money at the same time, and the banks are able to meet their obligations with the reserves they hold. However, if there is a sudden rush of withdrawals, the banks may not have enough reserves to meet their obligations, leading to a bank run and potential failure. The central bank, such as the Federal Reserve in the United States, plays a crucial role in mechanism of fractional reserve banking by setting the reserve requirements, providing reserves to banks when needed, and regulating the banking system to maintain stability. The creation of money through fractional reserve banking. Fractional reserve banking is a system where commercial banks keep only a fraction of their deposits in the deposits as reserves while lending out the rest. This means that when a customer deposits money in a bank, the bank is able to create new money by making loans to other customers. This process of money creation, also known as credit creation process, as it is one of the key functions of fractional reserve banking. The credit creation process works as follows. When a bank receives a deposit, it keeps a portion of the deposit as reserves and lends out the rest of the borrowers. This loan creates a new deposit in the borrower's account, which the borrower can then spend. This new deposit is considered part of the money supply as it is now available for use in the economy. However, the original deposit is still held by bank as a reserve, meaning that the total amount of money in the economy has increased. This process can be repeated multiple times as the loan money is deposited in another bank, which in turn lends out a portion of the deposit to another borrower, creating yet more new money. The result is that a single deposit can be used to create multiple loans and deposits, effectively multiplying the initial deposit. The creation of money through fractional reserve banking has a significant impact on the economy as it increases the overall amount of the money in circulation, which can affect interest rates, inflation, and economic growth. The role of banks in the fractional reserve banking system. Banks play a vital role in the fractional reserve banking system as they are responsible for creating and circulating money. Banks accept deposits from customers and hold a portion of these deposits as reserves, which are then used to satisfy withdrawals requests. The remainder of the deposits are used to extend loans and create new money. When a bank receives a deposit, it can use a portion of the that deposit to satisfy the reserve requirement set by the central bank. The remaining portion of the deposit is then available for the bank to lend out to borrowers. The amount that can be lent out is determined by the reserve requirement and the amount of the deposit held by the bank. The ability of the bank to create new money through the extension of loans has led to fractional reserve banking system being referred to as money multiplier system. This is because the amount of money in circulation is expanded through the creation of new loans, which in turn are used to create additional deposits. Banks also play a role in determining the interest rates charged on loans and the interest rates paid on deposits. The rates charged on loans are typically higher than the rates paid on deposits, allowing banks to generate a profit. Banks also engage in other activities such as providing financial services and investing in securities to generate additional income. The reserve requirement and its impact on fractional reserve banking. The reserve requirements is a percentage of the bank's deposit that it is required to hold in the reserve either as cash or deposits at the central bank. It is a tool used by the central banks to regulate the money supply in the economy and ensure the stability of the banking system. In fractional reserve banking, the reserve requirement is a key factor in determining how much money banks can create through lending. A lower reserve requirement means that banks have more money to lend, which can stimulate economic growth but also increase the risk of inflation. On the other hand, a higher reserve requirement limits the amount of money that banks can lend, which can slow down economic growth but also decrease the risk of inflation. In the United States, the Federal Reserve sets the reserve requirement for member banks. Currently, the reserve requirement is set at 0% for the first 18.1 million in net transaction accounts and 10% for net transaction accounts above that amount. This means that the banks are required to hold 10% of their deposits in reserve at the Federal Reserve. Changes to the reserve requirement can have significant impact on the money supply and overall economy. For example, a decrease in the reserve requirement would allow bank to lend out more money, which can increase economic growth and stimulate consumer spending. However, it can also increase the risk of inflation and potentially lead to asset bubbles. Conversely, an increase in the reserve requirement would limit the amount of money that banks can lend, which can slow down economic growth but also decrease the risk of inflation. The multiplier effect and how it works on fractional reserve banking. The multiplier effect is a concept in fractional reserve banking that explains how a small amount of reserves can create a larger amount of money in circulation. The multiplier effect works through a series of action between banks and their customers. When a bank receives a deposit, it is required to hold only a portion of the deposit as a reserve, which is set by the central bank. The remaining portion of the deposit is used by the bank to make loans to its customers. The loans are then deposited back to the other banks, which also have a reserve requirement. This process continues with each bank holding a portion of the deposit as a reserve and lending out the rest until the total amount of money in circulation is many times larger than the initial deposit. For example, if the reserve requirement is 10% and a customer deposits $1,000 into the bank, the bank can lend out 900 of that deposit and must hold 100 as a reserve. The borrower then uses the 900 to purchase goods and services which are deposited into another bank. That bank can also lend out 90% of the deposit and the process repeats. The multiplier effect can result in a significant increase in the money supply, but it also increases the risk of a bank run if too many customers try to withdraw their deposits at the same time. In addition, it can lead to inflation if too much money is created without a corresponding increase in the production of goods and services. The impact of fractional reserve banking. on interest rates and inflation. Fractional reserve banking can have a significant impact on interest rates and inflation. When banks create new money through the process of lending, it can increase the supply of money in the economy, which can lead to inflation. This is because the increased supply of money can lead to higher demand for goods and services, which can drive up prices. On the other hand, the interest rates in the economy are also affected by the supply and demand of money. When there is a high demand for money, interest rates tend to rise, and when there is a low demand for money, interest rates tend to fall. In the case of fractional reserve banking, the creation of new money by banks can increase the supply of money in the economy, leading to a lower demand for money and therefore lower interest rates. Central banks play a critical role in managing interest rates and inflation in fractional reserve banking systems. They can adjust the reserve requirement for banks, which can impact the amount of money banks can lend and in turn supply of money in the economy. Additionally, central banks can influence interest rates through open market operations where they buy or sell government bonds in the market, affecting the supply of money and therefore interest rates. Overall, the impact of fractional reserve banking on interest rates and inflation is complex and interconnected. It requires careful management by both banks and central banks to balance the supply and demand of money in the economy and maintain stable economic growth. Advantages and disadvantages of fractional reserve banking. Fractional reserve banking has both advantages and disadvantages. One advantage of fractional reserve banking is that it allows banks to provide loans to individuals and businesses. By creating money through the process of fractional reserve banking, banks have more money available to lend out to borrowers. This can help stimulate economic growth by increasing the availability of credit and financing for investments and purchases. Another advantage is that fractional reserve banking allows for the efficient allocation of capital. Banks can use deposits to fund loans to businesses and individuals who need the capital, thereby supporting economic growth and development. However, there are also several disadvantages to fractional reserve banking. One of the main advantages is the potential for bank runs and financial crisis. If a large number of depositors try to withdraw their funds from a bank at the same time, the bank may only have enough reserves to meet the demands, which can lead to a bank run and the collapse of the bank. Another disadvantage is the potential for inflation. When banks create money through the process of fractional reserve banking, it can increase the money supply in the economy, leading to higher prices for goods and services. This can reduce the purchasing power of consumers and lead to inflation. Overall, while fractional reserve banking can provide many benefits for individuals and the economy as a whole, it also carries significant risks and challenges that must be carefully managed and regulated to prevent financial instability and economic crisis. Criticisms and controversies surrounding fractional reserve banking. Fractional reserve banking has been subject to many criticisms and controversies over the years. One of the main criticisms is that it is inherently unstable and can lead to financial crisis. Since banks lend out more money than they actually have on hand, there is always the risk that if too many customers try to withdraw their money at once, the bank will be unable to meet their demands, leading to a bank run. This can also lead to a domino effect where other banks also experience a run, causing a wider financial crisis. Another criticism is that fractional reserve banking can contribute to inflation. When banks create money through lending, it increases the overall money supply in the economy. This can lead to higher prices for goods and services as there is more money chasing the same amount of goods. There is also criticism that Fractional reserve banking creates a power imbalance where banks have too much control over the economy. Since the bank have the power to create money, they can influence the economy by deciding who to lend to and under what conditions. This can lead to a situation where banks prioritize their own profits over the needs of the wider economy. Lastly, there are concerns that fractional reserve banking is not transparent enough, as banks are not required to disclose how much money they have in reserves in any given time. This lack of transparency can make it difficult for regulators to monitor and prevent potential risks and abuses within the system. Despite these criticisms and controversies, fractional reserve banking remains the dominant system for banking around the world. However, it is important for regulators to continuously monitor and regulate the system in order to mitigate potential risks and ensure that banks are acting in the best interest of the wider economy. Okay, chapter 8, full reserve banking concept and differences. So, yeah, we are going through different uh, concepts of banking systems, right? So, we've seen debt money system, bond money system, debt free money system, fractional reserve banking, now full reserve banking. Yeah, then we go into the history of interest and usury, then history of income tax and its relation to debt money system. So these will there'll be topics. I mean, these are all like topics which are interconnected, right? So they will have similarities. We already read some of them in the other book. Yeah, then the important one, Milton Friedman's theory on debt money system. Yeah, Milton Friedman is an economist and like a famous one, and the concepts which he discussed, uh, so many things are currently in use in the modern economies. Then examples of debt free money systems, new economic models, gold standard and its historical significance, the role of central banks in the economy, functions and powers. There's a pimple. Oh, it's not a pimple, it's a hair follicle. I tried to pull it out and now it's swelled up. Shit. Okay. Chapter 8. Guys, the this fractional reserve banking, the concept and all, right, we'll actually discuss further with the like details eventually. Okay. Definition of full reserve banking. Full reserve banking, also known as 100% reserve banking, is a monetary system in which commercial banks are required to hold reserves equal to 100% of the amount of deposits they hold. Under the systems, banks would not be able to lend out more than what they actually have in reserves and therefore cannot create money through the process of lending. In other words, bank would act solely as financial intermediaries, taking deposits from savers and lending them out to borrowers. without the ability to create new money in the process. The idea of full reserve banking is based on the belief that current fractional reserve banking system creates excessive amounts of money, which can lead to inflation, asset bubbles, and financial instability. By requiring banks to hold 100% reserves, full reserve banking aims to reduce the amount of money in circulation and prevents banks from creating money through lending. Full reserve banking was first proposed by economists such as Irving, Irving Fisher and Milton Friedman in the 20th century as an alternative to the fractional reserve banking system. While the idea has not been widely adopted, it has gained renewed interest in recent years, particularly in the wake of 2008 financial crisis and concerns about the stability of the banking system. Historical background of full reserve banking. Full reserve banking has its roots in writings of several classical economists, including Adam Smith, David Ricardo, and Henry Thornton. These economists believe that a stable and efficient monetary system required full backing of currency with gold or other precious metals. However, it is not until the 1930s that the full reserve banking system was formally proposed by American economist Irving Fisher, who believed that it would prevent the recurrence of bank runs and financial crisis. Fisher's ideas gained traction during the Great Depression, which saw a wave of bank failures and runs. The US government responded by creating the Federal Deposit Insurance Corporation or FDIC, which provided deposit insurance to prevent bank runs. However, Fisher believed that the underlying problem of fractional reserve banking remained and that only full reserve banking could provide a stable and secure monetary system. In the decades in the decades since, full reserve banking has been advocated by several economists, including Milton Friedman, who saw it as a way to prevent inflation and increase stability of the financial system. However, it has not been widely adopted and remains a topic of debate among economists and policymakers. The mechanism of full reserve banking. The mechanism of full reserve banking is fundamentally different from fractional reserve banking. In full reserve banking system, banks are required to hold 100% of their deposits in reserve. This means that they cannot lend out any of the deposits they receive, as they must keep all of the funds on hand to meet withdrawal requests from their customers. Under full reserve banking, banks are no longer able to create money through the process of fractional reserve banking, as they are not able to lend out more money than they have on reserve. This means that the money supply is determined solely by the amount of currency in circulation, and any changes to the money supply must be made through government policy. The primary function of banks in full reserve banking system is to provide payment and transfer services to their customers. Rather than lending and investing, banks are able to generate revenue through fees charged for services as well as through investments made using their own capital. One potential benefit of a full reserve banking system is increased financial stability, as it eliminates the risks of bank runs and reduce the potential for systemic risk. However, this stability comes at a cost of reduced liquidity in the economy, as the ability of banks to create new credit is severely limited. Comparison of full reserve banking to fractional reserve banking. Full reserve banking, also known as 100% reserve banking, is a monetary system in which banks are required to hold a 100% reserve ratio, meaning that they must keep on hand an amount of money equal to 100% of the deposits made by their customers. This reserve is not used for lending but is held in separate account to ensure that all deposits can be fully paid out to customers at any time. In contrast, Fractional reserve banking allows banks to lend out a portion of the deposits they receive while keeping only a fraction of the deposits in reserve. One main differences between full reserve banking and fractional reserve banking is the level of risk involved. A full reserve banking eliminates the risk of bank runs or insolvency since all customers since all customer deposits are fully backed by reserves, ensuring that depositors will always be able to withdraw their funds. In contrast, fractional reserve banking creates a situation where banks may not be able to meet the demands of their depositors if too many customers try to withdraw their funds at the same time. Another difference is the impact on the money supply under full reserve banking. The money supply is determined solely by the amount of base money created by the central bank, while under fractional reserve banking, the money supply can be expanded by the amount of credit created by banks through loans. This means that full reserve banking tend to be more stable as it is not subject to the fluctuations in credit creation that can occur under fractional reserve banking. Overall, full reserve banking represents a significantly different approach to monetary policy than fractional reserve banking. While it has been historically less common than fractional reserve banking, it gained renewed interest in recent years as an alternative to the current monetary system. The creation of money through full reserve banking. In full reserve banking, the creation of money is different than fractional reserve banking. In full reserve banking does not allow banks to create money out of thin air by lending out more than their reserves. Instead, the money supply is determined solely by the amount of reserves in the banking system, which is controlled by the central bank. Under a full reserve banking system, banks would have to allow banks would have to hold 100% of their deposits in reserve either as cash or deposits at the central bank. Therefore, when a depositor puts money into the bank cannot lend out that money. Instead, the bank would act as a safekeeper of the deposited funds, charging the depositor a fee for the service. The bank would earn revenue from the fees charged to depositors rather than from lending. In this system, the central bank would have direct control over the money supply as it would be sole entity responsible for creating and issuing new money. This would ensure that money supply would be stable and not subject to fluctuations caused by bank lending. The creation of new money would occur through the central bank purchasing assets, such as government bonds, from banks using newly created money. This process is called quantitative easing and can be used to stimulate the economy during times of recession. However, the potential downside is that it could lead to inflation if too much new money is created. The role of banks in full reserve banking system. In a full reserve banking system, banks would have a different role than in a fractional reserve banking system. Instead of creating new money through lending, banks would simply act as intermediaries between savers and borrowers. Depositors would place their money in the bank, who would then lend out the money to borrowers. However, the banks would not be able to lend out more than they have in deposits since they are required to maintain 100% reserve ratio. The main role of banks in full reserve banking would be to ensure the safety and liquidity of deposits. Banks would still earn a profit by charging a fee for their services and by investing the funds deposited with them in various assets such as government bonds and corporate bonds. Banks would also be responsible for conducting credit assessments of borrowers to ensure that loans are made only to those who are creditworthy and be able to able to repay them. In full reserve banking system, banks would not be able to create money through lending. So there would be less risk of a credit boom and bust cycle. Overall, the role of banks in full reserve banking system would be more limited than in fractional reserve banking, since they would not be able to create money through lending. Instead, their primary role would be to safely and efficiently intermediate between savers and borrowers. The reserve requirement and its impact on full reserve banking. In full reserve banking, banks are required to hold 100% reserves for all deposits. This means that all the money deposited in the bank must be kept in reserve and cannot be lent out. This reserve requirement is usually enforced by the central bank, which regulates the banking system. The impact of the reserve requirement on full reserve banking is significant, since the bank cannot lend out the money deposited by the customers. They do not have the ability to create money through fractional reserve system. Instead, they can only earn revenue through fees and interest on the deposit they hold in reserve. This makes the banking system less profitable but also less risky. The reserve requirement has an impact on the money supply in the economy. Since banks cannot create money through lending, the money supply is fixed and can only increase through the injection of new money into the economy by central bank. This means that full reserve banking is less susceptible to inflationary pressures than fractional reserve banking. In addition, the reserve requirements provide depositors with greater confidence in the safety and stability of the banking system, as they know that their deposits are fully backed by reserves. This can help to prevent bank runs and financial crises, which can have significant economic consequences. However, the reserve requirement can also limit the ability of banks to provide loans to borrowers, which can slow down economic growth. It can also limit the availability of credit to individuals and businesses, which can be a disadvantage in growing the economy. The multiplier effect and how it works in full reserve banking. Unlike fractional reserve banking, full reserve banking does not have a multiplier effect. In a full reserve banking system, banks are required to keep 100% of their deposits in reserves, meaning they cannot lend out any portion of their deposits. As a result, banks do not create money through lending in the same way that they do in fractional reserve banking system. Because there is no lending and subsequent creation of new money in a full reserve banking system, there is no multiplier effect. Instead, the money supply is determined by the amount of currency in circulation and the amount of reserves held in banks. This means that changes in the money supply can only occur through changes in the amount of currency in circulation or changes in the amount of reserves held by banks. The lack of a multiplier effect in full reserve banking has both advantages and disadvantages. On the one hand, it reduces the risk of bank runs and financial instability, as banks are not creating new money through lending. On the other hand, it also limits the ability of banking system to provide credit to borrowers, which can constrain economic growth and investment. Overall, the lack of multiplier effect is defining feature of full reserve banking and sets it apart from fractional reserve banking. The impact of full reserve banking on interest rates and inflation. Full reserve banking is believed to have a significant impact on interest rates and inflation compared to fractional reserve banking. Under a full reserve banking system, banks are not allowed to create money through loans and they are only able to lend funds they receive in deposits. This means that there is no multiplier effect. The total amount of money in the economy remains fixed. As a result, interest rates are likely to be lower since there is less demand for credit and the economy is less prone to inflationary pressures. Full reserve banking is also thought to reduce the risk of financial crisis, as banks cannot create money through loans, which can lead to excessive lending and borrowing. and ultimately a collapse of the banking system. Since banks would be able to lend out since banks would only be able to lend the funds they receive in deposits, they would be less likely to engage in risky lending practices that could lead to insolvency. This would make the banking system more stable and reduce the risk of bank failures and the need for government bailouts. However, opponents of full reserve banking argue that it could stifle economic growth by limiting access to credit, particularly for small businesses and entrepreneurs. They argue that by restricting banks' ability to create money, the amount of credit available in the economy would be severely limited, making it more difficult for businesses to borrow and invest in their operations. This could result in lower levels of economic growth and job creation. Additionally, full reserve banking would require significant regulatory oversight and monitoring to ensure that banks comply with the reserve requirements, which could be costly and time consuming for both banks and regulators. Advantages and disadvantages of full reserve banking. Full reserve banking, also known as 100% reserve banking, is a monetary system where commercial banks are required to hold 100% reserve of deposits. This means that banks are not allowed to lend out more than the actual deposits they have received from their customers. This system differs from fractional reserve banking, where banks can lend out a multiple of the deposits they receive. One of the main advantages of full reserve banking is increased financial stability. With full reserve banking, banks are not able to create money through lending, which means that the risk of bank runs and financial crisis is reduced. Additionally, full reserve banking eliminates the possibility of inflationary pressures that arise from excessive lending by banks. Additional advantage of full reserve banking is increased transparency. Under this system, depositors know that their deposits are secure and are not being used for speculative purposes. This creates greater trust in the banking system and reduces the need for government intervention to ensure financial stability. However, one of the main disadvantages of full reserve banking is the reduced availability of credit. With full reserve banking, banks are not able to create money through lending, which means that the amount of credit available to borrowers is limited. This can lead to decreased economic growth and development. Another disadvantage is the potential for increased transaction costs. With full reserve banking, banks are required to hold a larger amount of reserves, which can be costly to maintain. This cost could be passed on to customers in the form of increased transaction fees. Overall, full reserve banking offers increased financial stability and transparency, but at the cost of decreased credit availability and potentially higher transaction cost. The adoption of full reserve banking would require a significant overhaul of the existing banking system, making it a topic of ongoing debate and discussion in the field of economics. Criticisms and controversies surrounding full reserve banking. Full reserve banking, also known as 100% reserve banking, has been a topic of debate among economists and policymakers. One criticism for full reserve banking is that it could limit the amount of credit available to businesses and individuals. With all deposits held in reserve, banks would not have the ability to lend out money in excess to their deposits, which could stifle economic growth. Another criticism of full reserve banking is that it could lead to a decrease in financial innovation since banks would no longer have the ability to create money through lending. They may not have the same incentives to develop new financial products and services. Furthermore, some argue that full reserve banking may not be practical in today's global financial system. The movement of the movement of capital across borders could make it difficult to enforce full reserve requirements and could lead to instability in the banking system. On the other hand, supporters of full reserve banking argue that it would lead to greater stability and security in the banking system. With all deposits held in reserve, there would be no risk of bank runs or failures due to excessive lending or risky investments. Additionally, full reserve banking could eliminate the need for government bailouts of banks in times of financial crisis. Since banks would not be engaging in risky lending practices, the likelihood of a systemic collapse would be greatly reduced. Overall, the debate surrounding full reserve banking centers on whether the benefits of increased stability and security outweigh the potential limitations on credit availability and financial innovation. Current examples of full reserve banking. Currently, there are a few examples of full reserve banking systems in practice around the world. One such example is the Swiss Wohlgeld initiative, which proposed a full reserve banking system in Switzerland. The initiative aimed to give the Swiss National Bank exclusive control over money creation, effectively eliminating the ability of commercial banks to create money through lending. However, the initiative was rejected by Swiss voters in a referendum in 2018. Another example is the Icelandic government's response to a financial crisis in 2008, which included the creation of a new type of bank called Sovereign Money Bank. This bank operated under a full reserve banking system that was designed to provide a safe and secure place for Icelandic citizens to store their money. In addition, some small community banks in the United States have adopted full reserve banking systems. For example, Bank of Prairie du Sa, it's French, I think, in Wisconsin operates under a full reserve banking system where all deposits are held in reserve and loans are made only from bank's own capital. This approach allowed the bank to maintain a high level of financial stability and security. Overall, full reserve banking systems are not yet widely adopted in practice and are often seen as a controversial and untested approach to banking and monetary policy. How full reserve banking differs from other monetary systems such as debt free money systems and gold standard. Full reserve banking is a monetary system that differs significantly from other monetary systems such as debt-free money systems and the gold standard. In full reserve banking, banks are required to hold 100% reserves against the deposits they receive from customers, which means that they cannot create new money by lending out more than what they have in reserves. On the other hand, debt free money systems allow the government to create and control money supply without the need for banks to create money through lending. This can potentially lead to more stable and predictable money supply, but it also requires a high level of trust in the government's ability to manage the money supply. The gold standard, which was prevalent in the past, tied the value of money to a fixed amount of gold reserves held by the government. This meant that the supply of money was limited by the amount of gold reserves available, which was seen as a way to maintain stability in the value of money. However, this system had its own drawbacks, such as limiting the ability of the government to respond to economic fluctuations. In comparison, full reserve banking can offer a more stable monetary system with less potential for bank runs or financial crisis. However, it may also lead to higher costs for banks and customers as they may have to pay higher fees to cover the costs of maintaining 100% reserves. Overall, each monetary system has its own advantages and disadvantages, and the choice of system depends on various factors such as the economic and political climate and societal preferences. The role of government in implementing and regulating full reserve banking systems. The implementation and regulation of full reserve banking systems would require a significant role by the government. Since full reserve banking systems require all deposits to be held in reserve, it would be necessary for the government to enforce such a policy through regulations and oversight. The government would need to establish guidelines for banks to maintain full reserves and to monitor their compliance. Additionally, the government would need to ensure that banks do not engage in activities that would require additional reserves, such as investing in high risk assets. Furthermore, the government would need to establish mechanisms for ensuring that banks can withstand unexpected shocks, such as a sudden run on deposits. This could involve establishing deposit insurance programs or other forms of financial support for banks in times of crisis. It would also be important for the government to establish regulations around lending practices and interest rates to prevent predatory lending and ensure that the lending practices do not lead to systemic risk. In terms of implementation, the government would need to work with the banking sector to transition to a full reserve banking system. This could involve providing financial support for banks to build up their reserves, as well as public education campaigns to help consumers understand the changes and the benefits of a full reserve system. Overall, the role of the government in implementing and regulating full reserve banking systems would be crucial to ensure the stability and integrity of the financial system. It would require careful planning and coordination between government agencies and banking sector, as well as ongoing monitoring and oversight to ensure compliance with regulations and guidelines. So that is full reserve banking, its concept and differences from fractional reserve banking. Okay, the next chapter is chapter 9, History of Interest and Usury from Ancient Times to Today. So usury is the high interest rate. So this is a long chapter. I mean, not that long, but still long. And I don't. I think we can finish it. We will try. We'll try. Okay. Definition of interest and usury. Interest refers to the amount paid by a borrower to a lender in exchange for the use of the borrowed money. Interest rates are typically expressed as a percentage of the total amount borrowed and are determined based on various factors such as borrowers' creditworthiness, the length of the loan term, and prevailing market conditions. Interest rates can vary widely depending on the type of loan, such as mortgages, car loans, and credit cards. Usury, on the other hand, refers to the charging of excessive or unlawful interest rates. Historically, the term usury was used to describe any interest charges, as charging interest on loan was seen as a violation of religious or moral principles. In modern times, however, the term usury is typically used to describe charging of interest rates that are considered to be exploitative or predatory. The distinction between interest and usury is not always clear cut, and what constitute excessive interest rate can vary widely depending on the context and prevailing norms. In general, however, interest is considered to be a legitimate component of lending and borrowing, while usury is viewed as a form of exploitation. Usury is typically prohibited by laws, and many countries have established legal limits on the amount of interest that can be charged on loans. Historical origins of interest and usury. The concept of interest and usury has existed since ancient times. In ancient societies, lending and borrowing were prevalent, and interest was charged on loans. The Code of Hammurabi, one of the oldest legal codes dating back to ancient Babylon, including provisions for interest rates and penalties for defaulting on loans. In ancient Greece and Rome, lending and borrowing were also common, and interest rates were regulated by the state. However, interest rates were generally high, and lending was mostly done by private individuals rather than by banks or financial institutions. In Middle Ages, the Christian Church prohibited usury, defined as charging excessive interest rates on loan, and considered it a sin. This prohibition created a stigma around interest, and lending was often done by Jews and other non-Christians who were not bound by the same religious rules. In the Renaissance period, the stigma around the interest began to fade, and lending and borrowing became more prevalent. This led to the emergence of modern banking and financial systems, and interest rates began to be regulated by the state. Today, interest is a fundamental concept of modern finance, and lending and borrowing are essential components of the global economy. However, the concept of usury still exists in some cultures and religious traditions, and there are ongoing debates about the morality. Oh, why do I think of mortality, man? There are ongoing debates about the morality and fairness of interest rates and lending practices. The role of moneylenders in ancient societies. Moneylenders played a crucial role in ancient societies as they provided a means for individuals and businesses to access capital. In many ancient cultures, including those in Mesopotamia, Egypt, and Greece, moneylenders were often members of a wealthy and influential class. They would lend money to farmers, merchants, and other borrowers, charging interest on the loan. In Mesopotamia, for example, the Code of Hammurabi, circa 1750 BCE, regulated the practice of money lenders and set limits to the amount of interest they could charge. In ancient Greece, money lending was often associated with the temple priesthood, and interest rates were typically high. In Rome, moneylenders were often foreign traders who charge high interest rates on loans to Roman citizens. While the role of moneylenders varied depending on the culture, they generally provided an essential service for those who needed access to capital. Money lending allowed farmers to purchase seeds for their crops, merchants to finance trade, and individuals to pay for unexpected expenses. However, it also led to debt and financial insecurity for borrowers, especially those who were unable to repay their loans on time. As a result, Usury laws were implemented in many societies to regulate the practices of moneylenders and protect borrowers from excessive interest rates and predatory lending practices. The evolution of interest rates and lending practices over time. Lending and borrowing have been part of human societies since ancient times. In early civilizations, lending was primarily done through informal arrangements where individuals would lend money to friends and family members. As societies became more complex, moneylenders emerged and lending became a business. In ancient Mesopotamia, around 2000 BCE, the Code of Hammurabi regulated lending practices and set interest rates. During the Middle Ages, the Catholic Church prohibited charging interest on loans, and lending was limited to Jews and other non-Christians. However, as trade and commerce grew in Europe, so did the demand for credit. In response, moneylenders such as the Medici family in is it Medici? Is it Medici? Yeah, it's Italian, right? Medici family in Italy emerged. I don't know if it's right or not. I'm gonna say Medici. It sounds fun. Medici family in Italy emerged charging high interest rates on loans. The Industrial Revolution brought significant changes to lending practices with the emergence of modern banking institutions. The Bank of England was established in 1694 and other banks soon followed, providing individuals and businesses with access to credit. With the growth of financial markets and increased competition, interest rates became more standardized and the cost of borrowing decreased. In the 20th century, governments and central banks began to play a significant role in regulating interest rates and credit markets. Central banks use monetary policy tools such as changing interest rates to influence economic growth and control inflation. Today, lending practices have evolved significantly with the emergence of digital lending platforms and fintech companies. These new players offer innovative ways to access credit, and interest rates can vary widely depending on the lender and borrower's creditworthiness. Despite these changes, the history of lending and interest rates demonstrates the enduring importance of credit in economic growth and development. Religious and ethical considerations surrounding interest and usury. The charging of interest on loans has been a topic of debate throughout history, with religious and ethical considerations playing a significant role. Many of the major world religions, such as Christianity, Judaism, and Islam, have specific guidelines and restrictions regarding the charging of interest and usury. In Christianity, charging interest was initially prohibited by church with the belief that it went against the principles of charity and social justice. However, church stance on interest changed over time, with some theologians arguing that it was permissible as long as it was reasonable and just. In Judaism, charging interest to fellow Jews was prohibited, but it was allowed to lending to non Jews. In Islam, the charging of interest or riba is strictly prohibited with the belief that it creates injustice and exploitation. Outside of religious context, ethical considerations regarding interest and usury have also been debated. Some argue that charging interest is inherently exploitative as it places a burden on borrowers who may already be struggling financially. Others contend that interest is necessary for the functioning of a modern economy, as it provides an incentive for lenders to extend credit and for borrowers to repay their debts. Overall, the ethical considerations surrounding interest and usury continue to be an important factor in debates over lending practices and interest rates policies. Usury laws and their impact on lending practices throughout history. Usury laws are regulations that limit the amount of interest that can be charged on loans. These laws have a long history dating back to ancient times. Usury laws were typically put in place to protect borrowers from being charged excessive interest rates, which could lead to financial ruin. In many cases, usury laws were tied to religious and ethical considerations. For example, in medieval Europe, usury was considered a sin by the Catholic Church. Usury laws were put in place to enforce this moral code and prevent exploitation of vulnerable borrowers. Throughout history, usury laws have had a significant impact on lending practices. In some cases, these laws have led to the emergence of alternative forms of lending that are not subject to usury restrictions. For example, pawnbrokers have often operated outside of usury laws by charging fees instead of interest on loans. In the modern era, many countries have repealed or relaxed usury laws. This has led to the emergence of a wide variety of lending practices and products including payday loans, high interest credit cards, and subprime mortgages. Critics of these practices argue that they can lead to financial exploitation and contribute to economic inequality. Despite the relaxation of usury laws in many countries, some jurisdictions still maintain strict regulations on lending practices. For example, in the United States, some states have implemented interest rate caps on payday loans and other types of high interest lending. These regulations are designed to protect borrowers from financial harm and ensure that lending practices are fair and transparent. Debates over the morality of interest and usury in medieval and Renaissance Europe. In medieval and Renaissance Europe, there were intense debate over the morality of interest and usury. The Catholic Church, which wielded significant power during this period, had long maintained that lending money at interest was immoral and sin. Many theologians and religious leaders believed that charging interest on loans was exploitative and unjust, as it allowed lenders to profit from the misfortune of others. However, not everyone agreed with this stance. Some argued that lending money at interest was necessary for economic growth and development, and that it was not inherently moral as long as the interest rate was fair and reasonable. Others pointed out that Bible did not explicitly forbid lending at interest, and that the prohibition on usury referred specifically to exploitative lending practices. Despite these debates, the Catholic Church maintained its opposition to usury throughout the medieval and Renaissance period. This stance was reflected in the laws of many European countries, which established strict limits on the amount of interest that could be charged on loans. These laws were intended to prevent lenders from exploiting borrowers and to ensure that interest rates remained fair and reasonable. The emergence of modern banking and lending practices. The emergence of modern banking and lending practices can be traced back to early modern period, particularly the 17th and 18th centuries. During this time, advances in trade and commerce led to increased demand for credit, which in turn led to development of new financial instruments and institutions. One of the key developments during this period was the establishment of modern banks, which were able to offer a range of financial services, including deposit taking, lending, and currency exchange. The first modern banks were established in Western Europe, particularly in Amsterdam and London, and were initially focused on servicing the need of merchants and traders. Another important development during this period was the emergence of joint stock companies, which allowed investors to pool their resources and invest in large scale commercial ventures. This enables companies to raise large amounts of capital for projects such as colonial expeditions, and infrastructure development. As lending and investment became more widespread, a number of new financial instruments were developed to facilitate these activities. For example, bills of exchange and promissory notes were used to facilitate international trade, while bonds and shares were used to raise capital for large scale projects. Overall, the emergence of modern banking and lending practices represented a significant shift in the way that finance was conducted and laid the foundation for the development of the complex financial systems that exist today. The impact of interest rate on economic growth and development. Interest rates play a crucial role in economic growth and development. In general, low interest rates encourage borrowing and investment, which can stimulate economic activity and job creation. On the other hand, high interest rates can lead to a slowdown in borrowing and investment, which can stifle economic growth and lead to higher employment rates. Central banks such as Federal Reserve in United States or the European Central Bank have the power to influence interest rates by adjusting the money supply and setting interest rate targets. For example, during a recession, a central bank may lower interest rates to encourage borrowing and investment, which can help stimulate economic growth. However, the impact of interest rate on economic growth and development can be complex and multifaceted. In some cases, high interest rates may be necessary to combat inflation, which can also have a negative impact on economic growth. Additionally, the impact of interest rates can vary depending on specific economic conditions of a country or region. Overall, interest rates are an important tool for policymakers to manage economic growth and development. However, finding the right balance between low interest rates and stimulate growth and high interest rates to combat inflation can be a challenge. The role of central banks in setting interest rates. Central banks play a crucial role in setting interest rates in their respective countries. Interest rates are one of the main tools that central banks use to control money supply and stabilize economy. When a central bank wants to stimulate the economy, it may lower interest rates, making it cheaper for individuals and businesses to borrow money. This increased borrowing can lead to increased spending and investment, which can stimulate economic growth. On the other hand, when a central bank wants to slow down the economy, it may raise interest rates. This makes borrowing more expensive and can lead to decreased spending and investment, which can slow down inflation and prevent an overheated economy. Central banks typically use a variety of factors to determine the appropriate interest rate for their economy, including inflation rates, economic growth, employment rates, and the state of the global economy. The interest rate set by the central bank serves as a benchmark for other banks and financial institutions, which then set their own interest rates based on this benchmark. In some countries, central banks operate independently from the government and have the power to set interest rates without interference from politicians. The independence is intended to prevent political pressure from influencing monetary policy decisions, which could potentially harm the country. The relationship between interest rates and inflation. Interest rates and inflation have a strong relationship. Interest rates are the cost of borrowing money, while inflation is the rate at which the price of goods and services rise over time. When interest rate rise, the cost of borrowing increases. Hey Subish, what's up, bro? Good morning. With interest rates rise, the cost of borrowing increases, and this can lead to decrease in consumer spending and a slowdown in economy. On the other hand, when interest rates are low, borrowing becomes cheaper, and this can stimulate spending and economic growth. Inflation can be affected by interest rates in few different ways. When interest rates are low, borrowing becomes cheaper, and this can lead to an increase in spending and investment, which in turn can lead to higher inflation. Additionally, when interest rates are low, savers may choose to invest their money in riskier assets such as stocks and real estate, which can lead to asset bubbles and price increases. Central banks play a critical role in managing interest rates and controlling inflation. By adjusting interest rates, central banks can influence the borrowing and spending behavior of individuals and businesses, which can in turn which in turn can impact the overall level of inflation. In general, central banks aim to keep inflation within a certain range, typically around 2%, while also promoting economic growth and stability. Today do live at 5 p.m. Yeah, evening I can't do, bro. I can't. Uh, Different types of interest rates, such as nominal and real interest rates. There are different types of interest rates that are used in financial markets, including nominal and real interest rates. Nominal interest rates refer to the rate of interest that is quoted by financial institutions and represents the actual interest payment on a loan or investment. The nominal interest rate includes the rate of interest and any other fees or charge associated with the loan. On the other hand, real interest rate refers to a nominal interest rate adjusted for inflation. In other words, real interest rate reflects the purchasing power of interest payment after accounting for inflation. If the inflation rate is high, real interest rate may be lower than the nominal interest rate, which means that the borrower or the investor is actually losing money in real terms. Real interest rates are important for policymakers and investors as they provide a more accurate picture of a true cost of borrowing and the true return on investment. Real interest rates are also useful in understanding the impact of monetary policy on the economy, as the changes in nominal interest rate may not necessarily result in changes in real interest rate if inflation is also changing. Overall, understanding the difference between nominal and real interest rate is important for making informed financial decisions and for policymakers in implementing effective monetary policy. Why you can't? I mean, I can't because I can't. What do you mean, why you can't? I can't, that's it. I can't because I can't. The impact of interest rates on personal finance, such as mortgages, credit cards, and loans. Interest rates play a significant role in personal finance, affecting the cost of borrowing money, saving money, and investing. For example, the interest rate on mortgage affects the monthly payments and the total amount paid over the life of the loan. Similarly, interest rates on credit card affects the cost of borrowing money and the amount of debt that can accumulate. Mortgages typically have fixed interest rates, meaning the rate stays the same for the entire loan period. However, credit cards and other type of loan may have may have variable interest rate that can change over time. Consumers who are able to obtain lower interest rates on loans and credit cards may save significant amounts of money over the life of the loan. Interest rates also affect savings accounts such as certificates of deposits and high yield savings account. When interest rates are high, savers can earn more interest rate on their deposits. However, the interest rates are low, saving accounts may not provide much of a return, leading some savers to seek higher returns through riskier investments. Overall, the impact of interest rates on personal finance varies depending on the individual's financial situation. Those with high levels of debt may struggle to make payments when interest rates rise, while savers may struggle to earn a decent return when interest rates are low. You just lazy. I'm gonna see you tomorrow. Yeah, I'll see you later, bro. I'm lazy. Bro, you're calling me lazy. I woke up at 4 to do the stream and you call me lazy. No, not good, Subish, not good. International differences in interest rates and lending practices. Interest rates and lending practices vary significantly across different countries and regions of the world. The differences are driven by various factors such as economic policies, political systems, cultural norms, and historical factors. In developed countries such as the United States, the interest rates tend to be lower compared to developing countries. This is because developed countries have a more stable economy and the central banks have a greater ability to control inflation and maintain lower interest rates. In contrast, developing countries have less stable economies and have higher interest rate due to high risk of default. Furthermore, cultural norms and historical factors also influence lending practices. In many Asian countries, for instance, it is common for families to provide loans to their relatives without interest or with very low interest rates. In contrast, Western countries, commercial banks are the primary source of lending, and interest rates are typically higher. I'm, I'm stuttering. Huh? Another factor that influences lending practices is the regulatory environment. In some countries, governments set limits on interest rates and have strict regulations on lending practices to protect consumers from predatory lending. In other countries, governments take a more less fair approach to regulation, allowing lenders more freedom to set interest rates and lending terms. Overall, the differences in interest rates and lending practices across different countries have significant implications for global economic activity and financial stability. The impact of technological advances on lending practices and interest rates. Technological advances have a significant impact on lending practices and interest rates in recent years. The advent of digital lending platforms such as peer-to-peer lending has disrupted the traditional lending industry by making it easier and faster for borrowers to access loans and for lenders to earn returns on their investments. These platforms use algorithms and data analysis to assess the creditworthiness of borrowers and determine appropriate interest rates based on risk. This has led to more personalized lending rates for borrowers and higher returns for lenders while reducing the cost and overhead associated with traditional banking. Another technological advance that has impacted lending practices is the development of blockchain technology. Blockchain allows for secure and transparent record keeping of financial transactions, eliminating the need for intermediaries like banks and reducing transaction costs. This has led to the development of decentralized lending platforms where borrowers and lenders can transact directly with each other without the need for a central authority. Furthermore, advances in mobile technology and internet connectivity have made it easier for individuals to access financial services, including loans and credit. This helped. This has helped to promote financial inclusion, particularly in developing countries where traditional banking services may not be readily available. Overall, the technological advances have increased competition and efficiency in the lending industry, lending to greater leading to greater access to credit and more competitive interest rates for borrowers. Criticisms of current interest rate policies, such as low or negative interest rates. One of the main criticisms of current interest rate policies, particularly in developed countries, is the persistent persistent trend towards low or negative interest rates. This has been driven in part by the desire of central banks to stimulate economic growth and inflation, but has also been fueled by factors such as demographic shifts, slowing productivity growth, and a glut of saving in certain regions. Critics argue that the low interest rate can have negative effects on savers who may struggle to earn a reasonable return on their investments. This can be particularly challenging for those who are approaching retirement or who rely on investment income to cover living expenses. Low interest rates can also encourage risk taking and financial instability as investors search for higher yields in riskier assets. Negative interest rates, where depositors are effectively charged for keeping money in the bank, are even more controversial. While they may encourage spending and investment in the short term, they also risk distorting market incentives and could have unintended consequences such as reduced bank profitability and hoarding of physical cash. Overall, there is a growing sense among some economists and policymakers that the low interest rate environment may be unsustainable in the long run, and that new approaches to monetary policy and economic management may be necessary to promote stable growth and financial stability. The role of interest rate in financial crisis and economic downturns. Interest rates play a crucial role in financial crisis and economic downturns during economic growth. Interest rates are usually raised to keep inflation in check, which can lead to slowdown in economic activity. Conversely, during an economic downturn, central banks may lower interest rates to stimulate growth, economic activity by making it cheaper to borrow money. However, if interest rates are lowered too much, it can lead to excessive borrowing and investment in risky assets, creating a bubble that eventually bursts, leading to financial crisis. This was evident during the 2008 financial crisis, where low interest rates lead to excessive lending and borrowing, particularly in the housing market, resulting in a housing bubble that eventually burst, leading to widespread financial instability. Moreover, in the in a interest moreover in a low interest rate environment, savers may be disincentivized to save as the return on their savings is minimal, leading to a lack of investment in long term projects and ultimately affecting economic growth. Additionally, low interest rates may incentivize borrowing, leading to the accumulation of debt, which can be detrimental to a long term financial stability. In conclusion, interest rates play a significant role in the stability and growth of the economy. However, it is essential to strike a balance between stimulating economic activity and maintaining long term financial stability to avoid financial crisis and economic downturns. The future of interest rates and lending practices. The future of interest rates and lending practices is likely to be shaped by a variety of factors, including economic growth, technological advances, and changes in government policies. One political trend in the continued rise of digital bank and fintech, which could lead to more personalized lending practices and increased competition among lenders. This could potentially drive down interest rates for consumers and businesses. Another trend that could impact interest rates and lending practices is the shift toward sustainable finance and ESG investing. As more investors prioritize environmental, social, and governance factors, there may be a growing demand for loans and investments that support sustainable initiatives. This could potentially lead to the development of new types of lending products and lower interest rates for borrowers who meet certain sustainability criteria. The ongoing global pandemic may also have a significant impact on interest rates and lending practices. Central banks around the world have already implemented unprecedented measures to support economies during the crisis, such as cutting interest rates and increasing monetary stimulus. As the pandemic continues to unfold, it remains to be seen how these policies will evolve and what impact they will have on lending practices and interest rates. Overall, the future of interest rates and lending practices is likely to be shaped by a complex interplay of economic, technological, and societal factors. However, it is clear that the financial landscape is constantly evolving, and borrowers and lenders alike will need to adapt to changing conditions in order to succeed. So, that was chapter 9, History of Interest and usury from ancient times to today. And the next one is history of income tax and its relation to debt money system. So we'll discuss this. This chapter is important given the recent executive order, right, by Trump to abolish federal tax. Until 1913 in US there was no federal tax. No, there was no income tax at all. And from then it started with 1%. It started with 1% income tax. And look today where it is now. Holy shit. Everybody is complaining, right, about the income tax. Okay, so this chapter will be relevant in terms of that. Tomorrow we'll discuss this. Today it's 7 and I'll end the stream. So, yeah, we were reading Currency Conundrum, exploring the complexities of monetary systems. Fine. Okay, guys, I'll see you all tomorrow. Hope today you learned something, and tomorrow we'll discuss about the history of income tax, its importance, and how it impacts the economic systems. Fine. Bye. 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 Bye.